Welcome back to our second podcast on West Red Lake. I'm sitting with Gwen Preston, VP of Investor Relations. We're going to be going through some of the stuff that's been going on in the mining industry recently, confidence in mining, risk mitigation in mining, and we're going to relate some of those points into how we're prepping West Red Lake for success. So it's been a busy few months in mining. Some good fundraisers, some good capital raises, some good excitement. You know, we had the Osisko sale that also happened, so there are positives. There was the situation with Victoria Gold earlier in the year where they lost 82%, and now they're halted, and I think they're in receivership.
They're gone.
They're gone. They're dead.
It's over. Yeah.
Okay. That was a pretty large amount of capital.
Mine fail is what we'll call it.
Yes. And then the second one that recently happened is Ascot turned off their mill. And so the reason that these are really relevant to us is because West Red Lake was a failed mine by Pure Gold that you guys took over. So what is going on? What is it a plague? Is it something like why?
Is it contagious?
Why are these mines failing?
I mean, it's a funny thing to say. Is it contagious? I mean, it kind of is, and I say that because mining is really complicated, really complicated. And so the only way to make a complicated machine work well is to have deep expertise applied to all the different requirements of that problem with enough time and money applied.
Right.
Backing all of those experts who are working all those different angles, right? And mining as an industry struggles on sort of all of those fronts. So we struggle to have enough expertise because mining is such a cyclical industry that it's hard for people to stay in mining. You know, when you go through a really long bear market, people are like, they kind of give up and leave, or maybe they survive 2 mining cycles, but then they move on and do something different. So we do, and it's not a super appealing industry for young people to join because of the cyclicality of it.
Right.
Because, you know, maybe I start my geology degree when mining's hot, and by the time I'm finished it, there's no jobs in mining. So it's a difficult sector to develop deep expertise, and it takes a lot of time and experience. And so these things, it's hard to have a lot of expertise. We're short on it. The whole baby boomer retirement thing, you know, piles onto that. And then you need the capital to back the experts if you have them.
Right.
Capital raising has been really hard in mining. You know, over the last few years, it hasn't been a terrible mining market, but it certainly hasn't been an easy market to access a lot of capital. So it's hard to have enough money. So then decisions can often end up being made driven by limited capital instead of being driven by best mining practices.
Oh, interesting.
So that's a thing.
Okay.
And then time. So time is one of these funny things. We always talk about how long it takes to get a discovery into production, and it's a really long time. But then when you kind of need the time, you maybe don't have it. What I mean there is like when you're actually in the throes of doing your feasibility study and lining up your capital and then spending your capital to build the mine. Well, the longer you spend building your mine, the longer you're paying interest on your capital before you actually start making money to repay that big burden. So you end up a little bit squeezed for time at the crux of it, which is sort of the build and ramp up phases. You're always a little bit squeezed for time. So there's just some aspects to mine building that the things that are needed are actually some of the hardest things to come by in mining. And that ends up being a bit contagious because those things are pervasive. Maybe pervasive is a better word than contagious. They kind of exist across the space. And the big mining bull market of 2004 to 7 or 9, or 10, depending how you like to capture it, exaggerated all of that. Because there was such an influx of excitement and people into the space without enough expertise.
Right.
Money was misspent, and then everything came crashing down. And since then, money has been harder to come by. There are fewer people. Like people started retiring. People left the space because it was such a terrible crash, and so it sort of almost has gotten worse since the last really huge bull market in mining. So. Yeah, it's a bit of a plague in the space.
Yeah, because, you know, if it was like 1 or 2, then it'd be like, oh, there's some, you know, abnormal actors or whatever. But it's like 1, 2, 3, you know, and so you start to kind of see a pattern. But this might be a stupid question, but I always thought of the actual metals as cyclical rather than the whole industry as cyclical.
I mean, they're not, you can't separate them, right? If metal prices are rising, investors in general are interested in putting money into mining companies. When money's available, then you can build mines and you can hire people and you can expand. But the reason that the metal prices go up in the first place is because the world is short on those metals. The prices rise, more money comes into the space, you build the mines, then you answer the supply crunch. Often you over answer the supply crunch, you end up with oversupply, and then the metal prices come down and the companies have to shrink back down and they have to fire people. And so it's all one and the same. They're very much tied together.
Interesting. So the industry as a whole is quite cyclical because of the fact that it's actually driven really by supply and demand.
Yeah,
like when
supply
you think
and demand that drives it for sure.
When you think, but it's a different kind of, it's a more rational supply of demand, I would almost call it, because like consumer goods is supply and demand as well.
Right.
Like for example, I buy a computer because I need a computer, but you never really need a $5,000 MacBook or whatever it is, right? So that's where it's like it's more irrational.
And I mean, yes, like, so metal demand is very fundamental to growth, right? You can't build a building, make a transmission line, create a new factory, build a computer. You need the metals for that. So like you say, it's very fundamental, the need, and sort of inarguable. The other factor that makes the supply demand argument so important is that it takes so long for supply to answer. Because it takes so freaking long to build a mine and because lots of mines fail. It takes a really long time for new supply to answer when there's a gap. Because the metal prices don't start to go up until the gap is like right here. And then companies need several years to get that project that they've been slowly moving along sped up and built and producing. So you end up having these supply gaps that get bigger than they would have if supply could be turned on quickly. Supply can't be turned on quickly, so the gaps get bigger and it amplifies the peaks and the troughs of the cycles.
Yeah, because it takes longer to get the metal out of the ground. So then, Victoria Gold, they went belly up mainly because of a landslide for their heap leach.
Yeah.
A rather bad chemical got leaked into some...
Yeah, it's
rivers.
Cyanide ended up leaking out of their tailings dam. I mean, it's two factors. It's the fact that cyanide, they had a big heap leach facility, ground up rock, put on, irrigated, so flooded, so to speak, with water containing cyanide. Cyanide pulls the gold out of the rocks, and then you gather up the water at the bottom of the thing, and it's all contained in a totally impermeable barrier. So none of that cyanide water escapes the pond, so to speak, that all this rock is in. We don't know. We don't have any expert studies yet on precisely what happened
it's been
on the
pretty
Victoria
quiet.
Gold heap leach pad. It's too soon to know and things like that. But a few factors are quite apparent. They didn't have a large flat space to make their heap leach facility. It's just quite mountainous there. So they had to, it was kind of want to call it like a valley fill heap leach. So instead of a big flat area with a modestly deep pile of rock, they had quite a deep pile of rock in a bit of a valley because there just wasn't another space to put the heap leach. So that meant that it was quite a tall stack.
Right.
So that's always going to increase the stability risk of your big pile of crushed up rock. And then Victoria Gold is also in a cold place, and they always had the plan to not irrigate the heap leach pad in the winter because it didn't make sense. Things are too cold. You can't run water in the winter. But it was a very expensive mine to build, and, like a lot of mines, it had some struggles at the start. So they needed to produce as much gold as they could to repay the debt that they took on to build the mine. So they did keep shrinking down on the amount of time where they didn't irrigate the heap leach.
Interesting.
They were putting water onto the heap leach pad in the cold. It seems like they were pushing the pad is the best way to say it. They were trying to get gold out of the pad maybe faster than a patient approach would have
Right.
pulled gold out of the pad. And that impatience, if you want to call it that, was driven by the need to repay debt.
Yeah.
That's the thing about building a mine, is that it's a huge capital spend, so you have this big debt burden, and you need to be able to repay that debt. So it seems like they pushed the pad, and that likely was one of the contributing factors between the depth of the stack and pushing the pad. Likely that those were contributing factors to the fact that then the stack of wet sand cracked and tumbled, and then it took out infrastructure and it broke that impermeable barrier, so water came out, cyanide got into the environment, infrastructure was destroyed. Yeah.
And that was the end of Victoria Gold.
Yeah.
Basically. And then, but Ascot is a little bit of a different story.
Ascot's quite a different story. So Ascot's a mine that only turned on, Victoria had been running for quite a few years already. Ascot's a mine that really only turned on a couple months ago. This is a high-grade gold mine in British Columbia. And it was a mine many, many years ago, a really rich gold mine that mined 400 tons per day.
Wow.
So that sort of number. So quite a small mine, but that's often a good way of mining a really high-grade situation. You go in and you pick the cherries, right?
And that was a long time ago.
That was a long time ago. I don't want to say the dates, but I bet it was in the 30s, the 20s, that sort of, maybe the 40s.
So
I'm not sure.
technology is way different.
Yeah, so it was a long time ago. Ascot came in and bought this asset and decided to go quite big. So they built a 2,400 ton per day mill, which is, I think, if you ask most people in mining, that's a big mill.
Yeah.
To try and feed from an underground mine. It's doable. Just today, Kinross put out a study for their Great Bear mine. It's going to be a combined open pit and underground, but they're expecting to pull 6,000 tons per day out of their underground operation when it's just an underground mine. So you can pull that kind of tonnage out of an underground situation, but it's really tough. You need to have a lot of working faces, so a lot of places where you're mining, and ideally you need to have each of those working areas happen with a larger scale mining method.
Okay.
Kinross is planning long hole stoping, which is a higher volume underground mining method than the more pick the cherries out, cut and fill, which is what you usually use if you have quite narrow areas or if you're trying to work around old mine workings, things like that.
Oh.
So we all were like, okay, 2,400 tons per day. That's a lot. But
ambitious.
Let's see. That's ambitious, but it would be amazing if you can do it. Let's see. And when they announced the mill pause last week, it is because they have insufficient working faces and underground development. So their plan is to pause milling and spend 3 to 6 months getting access to more places where they can mine underground, in the hopes that means that they can pull enough rock out of the ground to feed this sort of beast of a mill.
Right.
They're now in a tough spot because, like with Victoria, they have a pile of debt.
Right.
They need to service that debt.
Right.
So they're going to need grace from their debt provider. Specifically, the debt provider is going to have to let them not pay for some period of time.
3, 6 months,
whatever it is. Exactly.
Yeah.
And they're going to need to access a big pile of money to pay for all the underground development that they need to do to catch up. So those are two big asks. We'll see. They're obviously out there working on doing those things right now. But yeah, so Ascot...
They took a hit. I mean, if you look at their year to date, by mid-April, they were up 62%. And now since that peak, they're down 81.5%.
Yeah, so...
In the last week, it just dropped.
I mean, in the last week, they're probably down 70%,
yes.
Right? Yeah, there was writing on the wall. They had started batch running the mill, so they were running the mill for 2 weeks and off for 2 weeks. So we already knew that they were having trouble getting enough rock out of the ground, enough mineralized material out of the ground. They're in a tough spot.
Yeah.
So how did they end up there? Well, they perhaps oversized their mill. They perhaps didn't choose an appropriate sort of mine plan. They didn't maybe right-size the operation. There's people I know who know the asset who think that there was maybe not enough definition drilling and confidence requirement in the resource before turning it into a mine plan. So maybe their model wasn't good enough, their underground model. They certainly didn't do enough development. They didn't do enough proactive
Yeah.
development underground. Set yourself up for success by giving yourself lots of places where you can mine before you turn on the hungry mill. And I mean, that's easier said than done. I say, sure, just set yourself. That costs a lot of money.
Yeah.
Right? I just said they probably need, I mean, I'm making up this number, but do they need $50 million right now to do the kind of development that they're describing over the next 6 months? It's that kind of ballpark.
Yeah.
So it's not easy. You need access to a lot of money to set yourself up for success. But that's certainly, I mean, that's the stated thing that they did wrong, is that they didn't do enough proactive development to get into enough places to be able to feed their mill.
Which kind of goes back to, why does this happen in the beginning? And they needed capital.
Yeah.
And they needed
to get
experts.
to production. Yeah.
They had to get into production because there is not a lot of capital. So it's kind of like that self-fulfilling prophecy, where it's like, I'm going to rush this because I don't have a lot of time left with my debtors or whatever it is, or the experts.
Everything will just be easier once I get to production, because then I'll be making money, and then money will help fix all the things. But that's hard to do. Getting into production is hard to do. I started this conversation by saying mining is incredibly complicated. So if you try and rush through an incredibly complicated process, the odds of making mistakes are high. Yeah. And that's the story of what Pure Gold did at Madsen too. They rushed through a complicated process. They didn't spend enough time or money or expertise on several of the key requirements within that super complicated process. Ascot seems like that's a very similar story. I mean, I have here on the table, I just made this table that goes through a whole bunch of risks that new mines face, and a bunch of examples from the last 15 years of mines that have really stumbled because of, modeling errors, because they thought that it was going to cost less than it actually cost, by a lot. We've had a whole bunch of examples in the last 10 years of initial cost estimates being blown out of the water, right? Like a mine that was supposed to cost 120 ends up costing 400. A mine that was supposed to cost 600 million costs 2 billion. We've seen several of those in the last few years. Plant commissioning issues, again, probably an expertise issue, a handoff issue, maybe contractor, company issues, social and permitting issues, groundwater issues, so not understanding your rock super well. There's a lot of things that can trip up a mine. This very complicated process, and you need to have the time, money, and expertise to tackle all of those questions to the extent that you can before you start mining.
I think that the thing that's unique about mining is that you can't really take the approach of a tech company where you go and you're like, I'm going to move fast and break things and then figure it out.
No.
Right? Because with mining, it's like, if you break something, it's a big deal.
And there isn't like a small, inexpensive way to start.
Yeah.
It just doesn't really work, between permitting and the fact that small is never that small. It's still quite expensive. Yeah. And then but permitting and safety is just so paramount to everything in mining. You can't really, start small and try it out. You kind of have to do. I mean, test mining, bulk samples, those are the only parallels to what you just said. Yeah. Maybe you can do some test mining. If you already have underground development, you can take a bulk sample to make sure that your modeling is good. So there's a few things, but they're not start small, go fast, break things, then fix. You can't do that approach in mining.
No. And so you guys have had a bunch of news that's come out over the past couple weeks, I think.
Yeah.
And a lot of it has been around this kind of mitigation, right? A lot of it has been the stuff that you guys were talking about a year ago, that you were saying we need to do this, and this so that we de-risk our mining operation and don't end up in the same place that Pure Gold did. You guys are actually doing that.
Yeah, I mean, this table that I created of mining risks, examples of mines that have tripped, and then what we're doing to address each of those risks. The title of this slide is Mining is Risk Mitigation. Really, that's what it is. There's so many things that can go wrong, and the way to set yourself up for likely success is to identify all of those potential trips and then do everything you can to address that risk. So it was a week ago that we put out our sort of site operations, our restart activities update. And if you go through the list of things that we're doing on site, they're all about mitigating risk. Like, you can look at all of them through that lens.
Yeah.
So definition drilling is absolutely fundamental to our entire restart approach. So we are pulling we are tightening up the drill spacing into our resource from about 20 meters to 6 meters.
Oh, wow.
And as we get all of that data about our model, we update the model in our internal version, and then you do a mine shape on it, and then you do manual adjustments based on geology that, just the numbers can't tell you. And then you apply a confidence matrix. So we only will mine engineer, so design stopes onto onto high confidence parts of our resource. So definition drilling is fundamental to what we're doing. So that's all risk mitigation. That is us doing everything that we can to ensure that when we go to mine this stope or this stope or this stope, we have done everything we can to know that we're going to know the tonnage and grade that we can pull out of those stopes. Because if you can't pull the tonnage and grade out, then you are going to fail before you even start, right?
Right.
So infill drilling and all of the mine engineering feedback loop that involves, absolutely fundamental. And then the other aspect of mining, if you've got your resource model and your mine engineering, if that's working, the other thing you need is efficiency in how you spend your money. So efficiency in how you move material out of your mine, and efficiency in how you crush, mill, and process that material. Efficiency in how you maintain all of the equipment that is part of that efficiency, and how you find and retain workers so you're not constantly hiring. So a lot of the projects that we're doing on site, you can view them through that lens. We're building a connection drift so that we can move material more efficiently. We're building a camp so that we can hire good workers
to stay.
And they stay, and we can manage our housing cost risk.
Right.
We're building a maintenance shop so that we can have a rigorous equipment maintenance program with good mechanics who are really hard to find unless we have a good maintenance shop. We're doing a tailings dam lift now so that we're not trying to do that significant capital project in the midst of all of the other things that happen during a mine startup.
Smart.
We're trying to manage the risk. That's why we're spending all the money now, doing all the projects now, to set ourselves up for understanding our resource, having a proactively engineered and developed mine plan, and then doing lots of efficiency projects to set ourselves up that we can manage our risk and our cost.
Yeah, like you guys found a lot of gold just in the mill when you took over from Pure Gold.
That was kind of a bonus, but yes, there was. When we go back to expertise, milling there's a lot of different things that you have to pay attention to make a mill work well.
I sense a theme.
Right? Exactly. Guess what? I'm like a broken. What am I saying? Broken record. A broken record right now. Guess what? There's lots of things. So one of the things that happened with Pure Gold is their SAG mill that spins around and smashes rock with steel balls to turn it into sand, so to speak, or finer than sand, but anyways. The liners of that were not installed properly. And because there was then a gap between the liner and the edge of the big drum, gold, which is really heavy, snuck through the cracks and gathered in that gap that wasn't supposed to be there. And there's lots of contributing factors. There was we get the sense, we hear stories that it was a reasonably chaotic site because there was sort of a lack of executive assistance in creating, in guidance at Pure Gold. It was also COVID. It was hard to find parts. It was hard to find people that layered on. They had some good people for sure, but they missed that error in the mill. Amidst all the other things that were going wrong, I'm not going to point my fingers at the people working in the mill. There was a lot of things errors that they were trying to manage.
It's a
But yeah, if you have expertise, we walked into the mill when it was turned off, and experts were like, "Wait, those aren't installed properly." And then, so that's something that we can fix. We do a new drill pattern, a new bolt spacing pattern, and we get the right liners and we put them on properly. And there's
just little things, right? That you tweak it here and there, and then the whole thing ends up operating smooth.
Yeah.
So I think like the three main things that we kind of talked about in terms of the risks for mines is capital, access to capital, expertise, and also the market.
Yeah.
Right.
And the market impacts your how quickly you're trying to do things, like sort of the pressure. The market really impacts the pressure. We at West Red Lake are lucky that we have had very good access to capital. We have been able to access the money.
Until you're in revenue, it's always a stress.
Exactly. There you
Yeah.
go. But we've been able to access the money to do the project. We are excited to get the mine going because the gold market is phenomenal right now. So
Yeah,
we
it
want
is.
to start selling gold into a $2,500 gold environment for sure. We're motivated for it. But we don't sort of have pressure from the markets. It's a bit different. But there can be lots of situations are flipped where the markets are really tough, or maybe the metal price is declining.
Yeah,
you
it
just
starts
you
to-
need if it's starting to go like this, you're like, I just got to get this mine going, or
Yeah.
else we aren't going to get it going until the next cycle, 10 years from now or
Yeah.
something. So, yeah, timing is a big one, and you have to make the right timing decision. Like Frank Juster and Shane Williams made the right timing decision 2 years ago when they started looking for an asset.
Yeah.
And they found Madsen and bought it 15 months ago, and then we're pushing as hard as we can to get it back into production to catch this gold moment.
Yeah.
So they're good at timing, and thankfully we have that on our side.
That's and Frank's also helps open the door for capital, I bet.
For sure. Yeah. One of the reasons that we've had access is because Frank is supporting the deal, and so he can make fantastic introductions and has great ideas too for how to access capital.
Yeah. And so now looking ahead, like despite the fluctuations in other projects, now, the stock's been holding pretty well. We've seen the ups and downs with the other companies in the market. You guys have put out some plans and some progress reports on what you've been doing. What are you looking at for the next 6 months?
I mean, the next 6 months is going to be dramatic for us.
Yeah.
Our goals as a company are to issue the prefeasibility study, to make very clear to the market how much more money it's going to cost, how big the mine is going to be, and what its parameters are, like what are we actually doing and when are we going to do it. And that should help the market understand that we're not an early stage development company. We are an on the cusp of production company.
Yeah.
Very different valuation metrics for those things,
Yeah,
which is
you
a
guys
fancy
are-
way of saying we should be rated higher as a pre-production company instead of have you even started to build the mine yet company.
Yeah, you guys are still trading at like some exploration company
Yeah.
share prices.
Yeah, because without that study, we just haven't been able to address the questions. And that's just because we bought this asset that already had all this stuff built, and then we've been working as hard as we can to turn it into the mine. And it wasn't until we'd done a whole thrust of work that we could produce the official mine plan that we're allowed to talk about. So that's going to come out in the coming months. So that's going to be a really big thing. We're also going to our goal is to bring in the rest of the needed capital to get ourselves through to comfortable production. I think that's also going to be an important moment in the market, because then people aren't going to wonder anymore, are they going to need to finance again? How much more money do they need? We want to bring in that money and then make clear that we understand how much money we need to get this thing running. And that's why we raised this much. That's our goal for sure.
So it's like de-risking at each level, where you say, okay, first here's our plan, and here's how much capital this plan requires, and we already have the
And we already have the capital. And in the meantime, we're just going to continue to we're going to continue to apply the expertise, which is doing all of the work on site to set ourselves up for an efficient mine.
Like the tailings dam project that you guys are doing
Yeah, the
now
tailings
and other
dam project,
things.
the connection drift, the mine, the camp, the mine dry, the maintenance shop, the propane reticulation. Like there's lots of projects that are going on.
Yeah.
So those are the huge news events that we expect to announce like before the end of the year. And then it's going to be, let's push this thing through to turning it on.
Yeah.
And in the meantime, we're also doing this test mining program. And the test mining program is really going to help us understand the details of what mining method to use when we're beside an old stope, when we're away from an old stope, when stopes are close together. Like
I love that, yeah.
We want to decide on our mining methods based on experience, not on guesswork. So we're doing a test mining program. And the other cool benefit is that the test mining program is going to create batches of stockpile on the surface that can be the first things that we process when we do turn that mill back on. And then we can do reconciliation calculations. We can be like, this pile of rock came from this exact stope where our resource model says it contains this. Let's see what it actually contains. And that can hopefully also help everybody understand that we've developed a very confident and accurate resource model. So that's another really important thing that will play out a little bit after the PFS and the money. Then we're going to really get into the test mining and the reconciliation work that should help, because one of the failings from the prior operator was absolutely resource accuracy and resource confidence. And so that's been fundamental to our approach, and we're keen to get into that reconciliation, being able to show, assuming that it works, being able to show that when we say we're going to mine this many tons at this grade, that is what we pull out of the ground and mill.
Yeah, it's great to see the approach of, like, you know, I'm sure there's pressure on Shane from multiple different people.
Oh yeah,
but still, but still being able to keep that discipline and being like, no, we're gonna do this the right way. We're gonna go through the right processes, because investors sometimes have their best interest in mind, which is return faster. I want my money. I want it faster.
Yeah.
I want a faster ROI. But if you succumb to that at certain times, you can kill the whole deal.
And this is where the expertise matters, right?
Yeah.
Shane has participated in or led like 6 major mine builds.
Yeah.
And so he has deep experience in seeing, you know, if you do this project and how it helps versus if you decide to not do or delay doing that project and what the impact is of that. He's lived it. He's experienced it. He's had to manage it, right? So he understands the risks that you absolutely need to address before, the risks that you need to be aware of during your ramp up, and maybe the risks that you can decide to manage later or that are more appropriate to manage once you're in operation. Like, that's what expertise can help you do, is understand which risks are really important to address when and how. And that's his knowledge base, experience base in that is how he's not succumbing to pressure to turn it on. He knows he does not want to turn this line on until he has good confidence that it's going to work. The last thing we want is this asset to fail again after all the work that we've done, right? And so that's where he stands, and he's not going to move from that position.
And that's important. You need that. Otherwise, if the leader of the company doesn't have that, you end up with a chaotic situation.
You end up with insufficient leadership on what needs to happen amidst all the pressure to just start producing gold. Well, we need to know what we need to do before we just start producing gold.
You know, it's so funny. There's two phrases that I love that this conversation brought up in my mind. First is that your personal economy does not need to reflect the state of the economy. So, like, if other mining companies are having struggles starting a mine or failing to start a mine, that doesn't mean that you need to make the same mistakes. If you do,
it's not actually a plague.
It's not actually a plague. It can be prevented by you doing things differently. And then the second one that I like is anticipation is a superpower in business. And so being able to anticipate the risks and when those risks come up and when to manage them is like a cheat code in this game. It's insane.
It's funny how the way that you phrased something just there. You're like, you don't have to succumb to the things that have been going wrong if you do it differently. Well, the tagline that we've been coming up with for West Red Lake is mining done differently. And it's a bit funny because what we're actually doing is just doing all of the work. And it's not actually, the work that we're doing isn't different, but what ends up being different is that we're embracing doing all the work and we're embracing managing risk as our fundamental business. That's our business model, is do the work, manage the risk. And then that is what we perceive as enabling us to be successful at mining. And that's what's has been missing in a lot of mine builds lately. Yeah,
and you know what? Hopefully this company, West Red Lake, can kind of be the first to instill confidence back into the space and turn things around, right? Because, you know, maybe everybody will start doing mining differently.
Then we'll have to come up with a new slogan, but that's okay. I'll take that.
You'll have much better problems at that point.
Yeah, exactly, for sure.
Awesome. Well, yeah, we'll circle back again in a month or so and see how things are and what else has gone on in the market. But it's been good to see. We've had a couple ups and downs. We had a Cisco that sold, which is great news.
Oh, yeah.
The Great Bear.
The Great Bear PEA out this morning.
Came out.
That's a big
was great.
mine. That's
that
a
was
big
a big
one.
mine. That was a big mine. And then we had Ascot, and then before Victoria Gold. So there's progress, there's some step backs, but overall the space is coming alive.
I think the Osisko deal also just highlights the major mining companies need near production assets, and there's not very many of them. So that's why they were willing to pay $2 billion to own the other 50% of that windfall asset.
Yeah.
Because there's just not very many assets out there that are close to production. So it's a special place to be with an asset that's close to being able to produce gold.
Because it's very hard to get it there.
Yeah. It's complicated. Have I mentioned that it's complicated?
Theme of this podcast. It's complicated.
Yeah.
Awesome. Well, thank you so much.
Thanks for having me.
Chat soon.
Yeah.